Welcome back to the Best of U.S. Investors, Two Regular Guys show. This is Mark over here, and I'm Trent. And today we're going to talk about market structure, how the big boys actually invest and trade, and how you can use that to your advantage over the long term. We're also going to get into some of the different reports, PPI, CPI, that are coming out this week, and what we should expect from them and how they could be interpreted by these markets. So let's get rolling.
All right.
Here we are.
Tuesday, August 13th, man.
Oh my goodness.
So again, we're from at about 11:15 on Central Time on Tuesday. So if we look at charts or anything, that's where they're at. So they close later tonight. They could be different depending on what comes out. And today, the producer price index came out and it was expected to slow in July, and it did. The final demand PPI rose just 0.1%. 0.2% was expected. Okay, that was month over month. And year over year, it was expected 2.7, and it was 2.2%. Okay, the market took that as great. Inflation's over. We can lower interest rates. That's what's going to happen with the Fed. We have some Fed people speaking today. We'll see how they take it. Again, Jerome Powell has been pretty strong on we need to get closer to 2% on his major index that he watches. Energy prices were picked up month over month, and the service prices went down the most since March of 2023. So when you think about that, inflation's down. We're done. So when you go to the grocery store, your eggs will be back to $1.59. Your bacon will be back to $3 for a package. Milk will be down to $1.25. Everything is cool. But the market's ripped.
Right.
However, on the other side, Goldman Sachs came out and they were looking at earnings reports. And this analyst, Scott Feeler, he told his clients the consumer is experiencing noticeable slowdown, moderation, or whatever term we choose to use. It's quite evident by now. And he says across industries, from luxury brands to airlines, travel companies, fast food chains, theme parks, consumer goods companies, profit warnings and management teams have signaled that the consumer slowdown continues to gain momentum. Low to mid-tier consumers seem to have reached their limit in absorbing price hikes on goods and services, thanks to depleted personal savings and maxed out credit cards. So as happy as this is, and inflation coming down, the consumers appear, and when you go and look at the reports and the conference calls, there's a piece out there that shows how many times they've talked about consumer slowdown, and it is the same. It hasn't been as high as it has since the pandemic. So the consumer is slowing down. Okay, and that is 70% of our economy. And again, that's a lagging effect, and we're going to get a retail sales report on Thursday, and we'll see how that plays out. Now, if that plays out that the retail sales are higher, we'll have to look at what inflation is and what retail customers are buying. So, watch the headlines, but dig into the report. So that's what I'm looking for. It's given us a really good chance after last week's, sell-off. We've had some really good setups in the swing trades, and our platinum members are busily swing trading today and yesterday and enjoying this volatility going back up. So just set your stops, always have an exit plan, make some money, don't get greedy, and be patient. And that's what we're looking at today. How about you? What are you looking at?
Mark, so as you know, I'm a curious individual, and I'm always looking for asking, yeah, but why? And I have known for years that institutions, let's just use banks and hedge funds, their intent is very much more, their time frame is longer. How they view time is much different. They have a different intention than you and I do. And so with those combination of things, they go about buying and selling or distributing money in a much different way than I think most of YouTube would say, as long, as well as the financial advisory industry, and just individuals in general. And so I started digging into this idea of how are they going about investing? Number one, how are they going about making decisions when to buy, when to sell, and what kind of time frame are they thinking? And so over the weekend, after doing some digging and going back to previous conversations I've had over the last 25 years, I've come to this conclusion. Number one, their time frame, they don't look at time. They don't look at time as in annual, other than it when it pertains to their bonus checks. What they're looking for is liquidity. And what do I mean by liquidity? They're looking for, if they take a position, be it long or be it short, that liquidity at some point needs to show up somewhere so they can reverse that position. And so most cases they're looking at is the time frame, or not from time frame, they're looking for liquidity. Where can they start building a position, accumulate shares or short shares of something, and then get it to rise to a level where there's a lot of liquidity, and then do the opposite and make money, and then in a lot of cases go in reverse. So what I wanted to show today was look at S&P SPY and look at a monthly chart of it, and then break it down from monthly to weekly and eventually daily. So I'm going to pull my chart up here. Now, I apologize for all the white lines, but it'll give you a sense of how these markets are interpreting boundaries in a sense. This over here. So this is SPY. It's the S&P 500 ETF. It's a monthly chart. And then we're going to start over here back in 93, June of 93, when SPY came about, which was a whole long ago. And as you can see, popularity in SPY didn't really start kicking in until May of 97. If you remember, May of 97, .com boom was in the beginnings, making a big move. And what you start to notice is each one of these is a candlestick. It represents a month in time. And what you start to see is, if you just looked from here, you really wouldn't have a reference to make a decision early on in 97 of where is this going. But if you span out, let's just say to 2010, you can see that the institutions started to recognize we can play this game. And so they would buy back here and then eventually find liquidity and sell their positions out. And this is June of 2000. They turned short and they ride this back down, but always came back to this little support level that was developed from November of 96 to May of 97. And so it came back, hit the support level, accumulation, they buy more shares of SPY, and then they start pushing it higher. And from this breakout point, let's just say here in October of 2003, they just pushed it higher and then a little higher up until October of 2007, where they started to exit the market starting in, well, I would say June of 07 until it really started exiting till December of 07. So they took their profits. And if they were a long-term investor, this is the ride they would look at. But what they are looking for once they entered the trade, they look for liquidity, opportunities to hit. Where is it going to peak? Well, where did it peak before? It peaked back here in 2000, August of 2000, and that became a resistance level. They, of course, wrote it down through the financial crisis, where it eventually bottomed, similar to where it bottomed in September of '02.
It's
And
pretty interesting. It's interesting. I don't mean to interrupt, but it's interesting. In 2000 wasn't that the dot-com bubble, and then the 2007 was the great financial crisis.
right, okay, and great. And now, '09, March of '09, it starts to move higher. Get some selling right here between some volatility at '09 to 2000 March of 10, but then you start to move even further. And where does everything go? Because this was an extreme selling, this created an incredible buying opportunity because it retested one initiated and one previous test. It retested that where it had hit, found support prior, and then started moving up. And it moved up, found more liquidity back in October of 11 or so, and you started to make bigger moves until you hit resistance, and that was in March of 13. And things started to change. Liquidity came into this market. I believe TARP was heavily being enacted. That was the money program to basically create liquidity in the market. And with liquidity in the market, we took off, and that's April of 2013. We eventually ran that course, found some resistance here. And right around 15, some things happened in 15 all the way until it started breaking out again. Let's just go to December of 16 and then December of 16. And you probably could have pinpoint this on liquidity. What was the Fed's policy at that time? Was it lower interest rates? Was he raising rates during this sort of base building period, this resistance area? What was he doing? And chances are he was loosening up the money supply, making it more available.
Didn't we go into like almost zero interest rates back in '09, and that's what kicked a lot of this off?
Oh, absolutely. Absolutely.
And then he went through some series where he tried to raise it a little bit, he being the Fed, and then it had to come back down because the market went through its, whatever they called it, I forget what they called it, craziness.
Right. Yeah, they have a term for every transitory or whatever. But after November 16, institutions blew through resistance level, what they thought at one time could have been a resistance level, created a resistance level back here in October 18, but came back down and retested an area that was formed back in September of 17, retested it for 2 months, moved higher, built a base at resistance back in September 18 over here in May, June of 19, and then it started moving higher. Okay, and then we came into the pandemic. In January of 2020, we saw the first turn in the S&P or SPY, and it created a resistance level at this point. Then March came around, or February, March, you bottomed, but you came back down towards a resistance level in March, or an extreme resistance level that was actually created between December of 2014 and November of 16. Came back, tested it for 1 month, found support. Market the next month on April, it came back down again, started out the month back down here where there was a base or resistance being built here, and then started shooting up.
You mean support, right?
Support. Thank you.
Yeah. Yep.
I was thinking
I do that all the time.
Yeah, I was thinking resistance here, which then eventually becomes support. So think about it. You get resistance, you retrace to support, you go back to resistance, and if they blow through it, then that becomes support. And so you see this pattern, this moving up, into December of 21. You had a pivot back down, a sell-off into December of 22, and we spent the year headed back down, but we went back down to a support level that was created between August 2020 and November of 2020. Came back, hit support, liquidity came back heavily back into the market, zero interest rates, Fed policy change, and then you had a breakout again in June of 2023, and hit a bit of resistance there because resistance was formed in August of 21, broke through it in November, closed above it in November of 23, and then really started taking off to where we are today. Where now, if we can see this in July, we had this candlestick pivot point from my perspective. Market didn't have enough to push this higher. There was not enough liquidity. You can see this in the length of the candles. And now August, we're starting to see volatility. Japan's Kerry trade, yen Kerry trade is starting to, it began to unwind because of Fed policy. And now if I'm looking at this, where does this come back to? If I'm looking at it from a monthly perspective, in my opinion, it comes back to between what is this, $455 and 470, say just $75 on the SPY. Today we're at 539. It'll most likely come back, in my opinion, to this resistance or support level that has been formed, and then we'll start moving higher again. What would cause that to happen?
You know what I see, kind of?
What's that?
I see the potential for a head and shoulders, that may come back all the way down to your 355 level,
Right
and then
here?
pop back up, and pop back up for another right shoulder.
Okay. Right.
And that would pop
here?
up to your 454 level,
Yeah.
and then back down. And if that pattern continued, you would have a head and shoulders. So that's what I'm seeing it. It's not there yet, but you can see where the left shoulder has been formed. And if this is the top, the head, then I would be watching for, a head and shoulders on the monthly.
Yeah.
You can do it. And that's very long term, but it would be interesting to see if that happens.
So you're saying come down to here?
Yep. And then back up to where the top of the other shoulder is. Yep.
So
and then back down.
Right.
And if it
here.
goes back down, and it goes past that neckline, okay,
Right here.
it could go down as far as that neckline, all the way up to the top of the head.
So it could go, okay, so
But that would be that's on the monthly. So stop right there. Okay.
Yeah.
So the neckline is a horizontal line that connects all those bottom parts of those triangles, from the left shoulder, right shoulder, and the center.
Okay.
And if you took a line from the top of the peak of the head, it went all the way down. Yeah, go down to the neckline.
Okay.
Keep going right there. All right. And if that, move it over to the right shoulder there. Okay.
Over here.
Yep, and pull it down to connect with the top of that right shoulder.
Okay.
Pull it down.
Hold on. I need to click it.
It didn't take.
So go here.
No. Straight down.
All right.
Straight down. Straight down. Right there. Stop. Now take that line and move it over to the right shoulder and down. Down. Okay. Down. Right to there. That's where head and shoulders would have us be if this pattern continued. That's called a head and shoulders, if that's what happens. Again, you're on the monthly chart. It's be interesting to look at the weekly and see if we see the same thing. So that would bring us down to what? Oops. That brings us down to 160, 170, somewhere in there on the SPY, if that happens.
170.
And look, yeah. And that's almost down to your other support level. And again, we're just playing with lines. So, but that is a technical pattern, and that is, if it breaks out, there's a better than 50% chance that that's where it would go. Now, not straight down like that, because it didn't come straight up. It would look kind of like the other side.
Right.
But and I'm not saying that's happening because we haven't seen the pattern yet, but it looks like almost two sections of it are complete. If we have a downward trend like you're thinking, and it comes down to the neckline, then I would be suspicious that we might be seeing a head and shoulders pattern.
And this would put you, if this, it's not totally to scale, but just let's say, basically you would see a bottoming potential in hypothetically in March of 27 or in the spring of 27, potentially. That's 2 years from
monthly,
now.
yeah. Yeah. And that's a
Yeah.
monthly, and that's a big deal. And we'll see what the weekly and the daily looks like.
Okay. This is a weekly chart that we're seeing here.
Oh, this is weekly. Okay.
Yeah. This one that we started with was monthly. So that's what we look at.
Oh, so it's the same, looks the same. Yeah.
Yeah. The weekly.
So weekly. Okay.
So probably if we just measured from here to here, drawing with market trend, and we just applied this. What's this
You were
say?
close.
Let's just, yeah, well, yeah. I would say about right there. There, there. Your width on this would be, say, right here.
I'll go down to the neckline, just on the first neckline hit. Yeah, somewhere in there. Yeah.
Okay.
And again, this is just speculation at this point, but
Yeah, yeah. It gives you an idea of how markets interpret time and patterns in human behavior. So June, roughly speculating, hypothetically, June of 27, we could see a major sell-off. In the meantime, from a risk management standpoint, you have a view of what is happening, how this could actually unfold. We don't really break, say, 557 or so on the SPY, then this pattern becomes part of human behavior memory, in a sense, I guess you could say. If you look at it from a daily,
yep.
sort of what you're looking at. Yeah. So you could see the bottom of that neckline by next year at this time. Or you could see a hit basically that neckline being the right shoulder being formed, or the beginning of the right shoulder being formed.
Yep.
Is that about right? Yeah.
Yeah. We'll see how it goes.
Yeah. But it also just gives you a perspective of using how these institutions actually think. They're doing exactly this to an extent. And that is, where is liquidity? Where is the opportunity? I look at a weekly and I go, where's liquidity today? Well, liquidity most likely will be down in this area. Over time, we'll go zigzag to get there, but they'll go look for liquidity. If they're short right now, and their short term is 2 weeks to 2 months, we could see a continuation of this downward trend overall. But that's I think this is part of that approaching investing, not just from what's happening in 15-minute charts, but going out in history. And I think of my brother-in-law who I had a conversation with this morning, who's in the oil and gas industry, and we were talking about just a pop in oil recently, and this, that, and the other. And I got to thinking, if I go back to all the way back in history of the WTIA crude or any level of oil, can I find these areas where liquidity has been created over time and look at where oil is going to trade? And when I was on the phone with him, I was looking on my Trading Views app, looking at USO, and I'm like, well, 110, 120 looks pretty, potential for it. So I think my plot of this story is span out in time when you're looking at charts look at all the history. Look at where support resistance has been created. Look at where liquidity dries up and liquidity becomes plentiful because institutions are taking the opposite side of that. You know, back in during the early part of this chart, the beginnings of this chart, you saw where they came in and they bought while we all retail investors were selling. They became liquidity in the market as SPY went up higher and got to a resistance level, the retail investor became the liquidity, and they sold to the retail investor and then took the opposite side and shorted it all the way down. So when I look at Nvidia or I look at Apple or Microsoft or any of the Mag 7, I look at it now and I go, they were selling all their stock from, say March until today to you and I, the retail investor. We became liquidity to them. We created a liquid market. They're taking the opposite side, and now they're going to short it all the way down to support, and then they'll become liquidity because the retail investor will sell out at that point out of fear. So when you're thinking about all this, do the opposite of what you traditionally think, or start to think in the opposite of what you traditionally think. So
I developed my trading plan, and that's what I stick to because that is how I maintain my discipline to not let emotions take over, basically. And again, what you were showing was longer term, more investment type looking at charts, whereas when we look at swing trading, like here's your Nvidia, like you were talking about, here's our channel as it's been going down since
that's not Nvidia.
Beginning of, oh, sorry, that's not Nvidia. Hold on. NVDA, you're right. Here's Nvidia, same, looks the same.
Yeah.
Channel go down. We came up yesterday and we talked about this. We hit over the 9, and again today we're moving up. We got MACDs and stochastics still doing well. We got the RSI, got some cells right here, then the 50, then the green line of death that we're seeing. We still see the Bollingers kind of converging and going sideways. So unless something happens, I'm not seeing this popping up too much higher with all this resistance ahead of us. So, this is the daily chart. Okay. And I can back the daily out and we can look at a year. Oops. And let me get rid of that thing, whatever that's doing. There we go. And you can see what's been happening with Nvidia. Okay. Yeah. Again, looks like a double top here. Come back down. We're seeing come back up, kind of sideways Bollingers. But again, this has been quite a run for Nvidia. But again, we're seeing the oscillators turn around a little bit. But how much higher can it go? I have this green line of death. That's been a pretty good line where it'll have resistance and pop back through. We'll see if something happens on they come up to earnings and earnings just blow it out, and their projections, for future earnings are way out there like everybody else has had. That'll get it above the green line of death, and it could go off to the races again.
Yeah.
Now, am I expecting it? I have no idea. I have no idea what it's going to be. All I can do is infer back to what I'm seeing from the other Mag 7s and what their earnings were. And they were okay on some, but they weren't outstanding. So we'll see.
Yeah. So let me show you what I'm looking at when I look at Nvidia, and this will give you sort of where I start to see support and resistance or scenario. And these lines are liquidity. And if I go back to March 8th of 2024, there was this resistance, or there was a lot of liquidity here. This is where institutions would sell into as it got into this peaking area or this green area, and they would buy back in to where they found where support was. This is where the individual investor starts to sell out of it. And they build a position from March of 24 to May of 24. And then they get their positions, they get enough allocation, and then they start pushing the stock higher. And you see it eventually becoming, getting to a point in June of 24, June 20th of 2024. And this is where you and I, the individual investor, two regular guys, get euphoric and go, it's going higher. It split 10 to 1. It's going to 200. It's going to 200, Mark. That's where
by the way, I didn't think that.
I know. I'm just being,
yeah.
I think most people do. But this is where the individual investor starts to buy the institutional investors' position that they built 3 months prior to that. And you see these push higher, big sell-off, and then they take it down. And they get down to a similar support level where liquidity was in March to May. And of course, you have the Japanese blow up. That was 3 days of selling. That was Monday of the 5th. It peaked out in selling, and they started buying. They became liquid. They became the market. And now they're pushing it higher a little bit. And they got 1, 2, 3, 4, 5, 6 days. Chances are you're gonna come into an area where they're gonna start selling their stock more and more. Their analysts are gonna upgrade something, and they're gonna start selling into it, and eventually bring it back down again. And so, this is my opinion, they may get back up to where we were here, back into the 139 range. But we're in this zone where, in my opinion, where they can turn on a dime and start pushing it low. Because if you think about it, since Tuesday of last week, the 6th, all it has been is buy the dip, the narrative, buy the dip. And now we've got reports coming out. CPI comes out tomorrow. And that will be very telling. So be cautious.
I see sales at 115.55, and then you go on to the 50.
You want to show your chart?
Yeah. Well, I mean, I can.
Yeah.
I mean, so I look differently, and Trent has a plan, and I have a plan, and that's what we talk about is when you trade, at least have a plan you're comfortable with that meets your requirements. And again, so see, I have on my program telling me there's sales at 115.55, and that's exactly where it went up and hit today.
Yeah.
And it has to get past that. And then we have the 50 at 120.05, and then my green line of death, as you can see, at 122.59. And so it can go past that, but it's going to have trouble. And I'm seeing these Bollingers not expanding away from each other, but actually converging and going sideways. So I'm expecting some sideways pattern movements, although we do have a little a MACD movement and some stochastic movement. You know, the oscillators are looking good, but we've had a pretty good run up the last 4 days, 4 or 5 days. So, but here we are. I mean, here's where we're going to have sells, and if we can get up, the next level is the 50. So, again, I'm not seeing it going straight up unless we get a great, market condition like the CPI goes down to negative growth, and everyone sees the market goes nuts, and then the Fed says, okay, we're going to lower interest rates by whatever, and that'll make the market go up, and then we'll go into recession, because that's what happens every time that the Fed starts lowering rates, because they're always behind the ball, and we'll see that. So that's what I expected. But I just look at the charts like you do. You look at a different way in your trading plan. I look at different in my trading plan. We have everyone in the platform, in the platinum platform, that they've made up their own plan on how they do it. They have different risk tolerances, different time frames, different stocks, different oscillators that they look at, and that's what we do. And then we get together in the live and we talk about it, and people explain their positions and why they do it, and I learn a lot there.
I think that's been one of the biggest influences on me, is talking to other people with a different approach, different amount of time in doing this. You have probably about 10 more years than I do in the industry, and you see it you were in the other side of the industry, and that was the backside of it. So you saw how these guys behave, and that's formed your investing guidelines. And I think that's the great thing about what we're offering here is to help you build a policy of how you go about investing, if it's long-term, short-term, or second by second. Having that community to bounce ideas off of, I think, is essential, especially in a market like we're in. So,
Absolutely.
yeah.
Yep.
Cool. Well, Mark, you got anything else you want to hit on?
Yeah, hopefully we didn't bore you guys too much with our little charts and stuff, but that's how we look at markets. Okay, we don't try to guess what when a stock price goes down and it's on sale. We try to back it up with some actual numbers, and it gives you a higher probability of success, a better opportunity to enter at a better price or get out before a good trade turns into a bad trade. And that's, just we're playing probabilities, and
Right.
the charts tell us that. And hopefully today you saw a little bit of how we look at charts and how we utilize charts.
Well, cool, Mark. Thanks for doing this with me. And
Always.
we'll if you have questions, you can always feel free to put questions in the comments. Check us out at bus13.ai. That's bestofusinvestors.com. Bus13.ai is just an abbreviation. It'll get you to the same place as bestofusinvestors.com. We have a 14-day free trial going. We're going to keep it on for a little longer, probably up until the Fed meeting, and then we're going to remove it. So take advantage of what we're doing. Check us out. We're always growing. We're always adding or subtracting value to. We're adding value always, but we're trying to always streamline everything so that we can give you what you truly need. So in the meantime, have a great day, and a great week, and we will see you later. See ya.
And cut. You always giggle after that.
So will you giggle after that?